A famous football player steps off the plane in Madrid, signs a contract, earns millions, and pays twice less than locals. Now it's called the Beckham Law, and it sounds like yet another rich guy treated unfairly well, but it's not. If you move to Spain to work, you might qualify for the Beckham Law and pay a simple 24% flat rate on your salary up to 600,000 euros, with tax only on Spanish income for up to 6 tax years. That means you can live under the Spanish sol, sip sangria, and still keep most of your gold coins outside the Spanish tax net. Let's cut to the chase. Spain has a special set of rules for newcomers who relocate to work. Régimen especial de impatriados under Article 93 of the Personal Income Tax Law. When you qualify, Spain treats you like a resident for day-to-day life, but taxes you in many ways like a non-resident. It's a have your churro and eat it structure. Your job income gets a flat 24% rate until it hits 600,000, and only the slice above that climbs to 47%. The regime runs for the year you first become a tax resident, and then 5 more, so 6 tax years in total. And because the regime focuses on Spanish source income, you're not treated as a Spanish treaty resident in these years. That last line matters for cross-border planning, and I'll come back to it in a bit. Your salary is a big pizza. Under the regime, all employment income during those years is treated as Spanish source pizza, even the slices you earned on workdays abroad. Spain taxes that pizza at 24% until it hits 600,000. Any extra slices are taxed at 47%. If a foreign country took a bite because you worked there for a few days, Spain lets you credit that foreign tax, so you don't pay twice. Expect your employer to withhold at 24% on the way and to bump to 47% only if your year's income from that payer crosses the top line. Okay, but what if you're not just an employee? What if you run a business? If you set up a real fixed base in Spain for your own business, with an office, people, equipment, you can break your eligibility unless you fit very specific entrepreneur or highly qualified professional routes added in 2023. The regime was redesigned to welcome employees, international teleworkers, certain directors, startup founders, and innovators. But it's not for people quietly building a full-blown local enterprise from a permanent establishment. If your plan includes premises, hiring, and Spanish clients under your own name, press pause and get the route right before you apply. In fact, the law got friendlier. The no prior residence look-back dropped from 10 years to 5, and new doors opened for teleworkers under the startup law, entrepreneurs with approved projects, and highly qualified professionals doing research and development, innovation, or training with at least 40% of their income from that work. Yes, they finally wrote modern jobs into a modern statute. Investment income and capital gains get different treatment while you're in the regime. Think of 2 baskets. Basket 1 is Spanish-sourced passive income, like interest from a Spanish bank or dividends from a Spanish company. That basket is taxed in Spain, but follows the simpler non-resident rules. Basket 2 is foreign-sourced passive income, interest from your bank abroad, dividends from a foreign company, gains on foreign shares. While you're under the regime, Spain generally leaves that second basket alone. There are always details with shares in Spanish companies or income from Spanish assets, but the big picture is steady. The 24% spotlight shines on wages, not your global portfolio. And then, there are wealth taxes. In case you didn't know, Spain has wealth taxes, including a temporary solidarity wealth tax. Under the special regime, you're taxed by what's called real obligation, which is a grown-up way to say only on Spanish assets, not on all your worldwide assets. If you own a valuable home in Spain, that can still matter, but your foreign art, your non-Spanish shares, and your overseas savings don't walk into the Spanish wealth tax net while the regime lasts. That's a quiet superpower for globally invested families. The flip side is equally important. Don't assume worldwide rules the moment you step off the plane. Under this regime, Spanish source is the star of the show. How to get in? First, you must actually become a Spanish tax resident in the year you want the regime, usually by spending at least 183 days in Spain or moving your center of vital interest there. Second, you must not have been a Spanish tax resident in the prior 5 tax years. Third, your reason for coming must fit one of the legal routes. You're employed in Spain by a Spanish company or assigned to Spain. You're an international teleworker using information technology tools, a status recognized under the startup law, You're appointed as a company director within the limits the law sets, especially if it's a pure holding company. You're an entrepreneur with an approved innovative project. Or you're a highly qualified professional serving an emerging company or doing research and development, innovation, or training with a meaningful share of your income from that work. Professional athletes cannot use the standard employment route. And remember the permanent establishment warning. If you create a Spanish fixed base for your own independent activity, you can disqualify yourself unless you are covered by an explicit new law pathway. And now let's talk about the deadline. The entire regime hangs on one form and one clock. Form 149 is the option. You must file it within 6 months from the later of your entry into Spain, or your start of activity as shown on your Spanish Social Security registration, or on your foreign coverage certificate if you remain in your home system. Miss that 6-month window and the regime is gone. Before you submit the form, the tax agency, AEAT, asks you to upload your supporting documents electronically. Your work contract or assignment letter, or your director appointment, or your entrepreneur or innovation approval, your Social Security registration or coverage certificate, your passport and Spanish tax number, and entry evidence. You receive a registration number for that upload, and you must include that number in the Form 149 filing. Do this carefully. I thought HR did it as not a legal position. Once you're in, Form 151 becomes your annual return while you're under the regime. It's the way you reconcile wages, withholding, and any foreign tax credits every year. Families get a thoughtful carve-in. Your spouse or the other parent of your children, and your children under 25, or older if disabled, can opt into the regime on their own if they also move, become Spanish tax resident, and meet the conditions. Each person files their own Form 149, and their clock starts and ends with yours. There's a guardrail that the sum of the family members' taxable bases must be less than the main taxpayer's base, which keeps the regime centered on the primary mover. The AEAT's manual even solves the deadline anxiety by tying each family member's 6-month window to the later of their entry or the main taxpayer's start of activity to give the longer period. It's almost generous by tax standards, which is like saying a cat is friendly for a cat. What will your payslip look like under the regime? Clean, for once. Employers with Spanish payroll run non-resident style withholding, 24% on employment income from that payer up to $600,000 in the calendar year, and 47% on the excess. If you have multiple employers, the year-end Form 151 is where everything reconciles. If you work some days abroad, keep excellent records of those days and of any foreign wage tax paid so the foreign tax credit can do its job. Picture your HR smiling because your documentation is neat. That smile is the rarest employee benefit. Here are the traps that catch the unprepared. Athletes can't use the employment route and must look at other paths. Freelancers who quietly morph into a Spanish permanent establishment by renting offices, hiring staff, and buying equipment can break eligibility unless they truly fit the new entrepreneur or highly qualified professional definitions. People miss the 6-month Form 149 window because they confuse arrival with actually starting work, or because they assume their employer filed it. And my favorite misunderstanding, thinking that foreign workdays are exempt from Spanish tax while on the regime. The law deems all employment income during the regime to be obtained in Spain, with a credit for foreign tax paid. That means your salary for workdays abroad still enters the 24% or 47% calculation in Spain during the regime years. Budget with that reality, not with wishful thinking. Another quiet trap is wealth tax on Spanish assets. While your foreign wealth is out, a valuable Spanish home is very much in, and you should plan purchases with thresholds in mind. Let's walk through a simple life cycle so you can see the movie rather than a slideshow. You arrive in March, sign a Spanish employment contract in April, register with Social Security, and set a giant reminder for 6 months after that registration date. You gather your contract, your Social Security proof, your passport, and NIE, and you upload everything to the AEAT portal to get the registration number. You file Form 149 on time and tell Payroll you're in the special regime so they withhold at 24% and track your progress towards $600,000. Your spouse arrives in June, files their own Form 149 within their own 6-month window, and starts their 6-year period in sync with yours. You work a few days in France and Italy and pay a bit of wage tax there. You keep those pay slips, and at year-end you put those credits into Form 151. Your portfolio sits abroad generating dividends and gains that generally don't get pulled into Spain during the regime, while your Spanish interest and Spanish dividends, if any, are taxed under the usual non-resident rules. You buy a house in Madrid and realize that wealth taxes look only at Spanish assets, so you plan financing and ownership to keep below painful thresholds. And because you read ahead, somewhere in year 4 you start modeling year 7, when the regime ends and you become a normal Spanish resident with worldwide taxation at progressive rates. That gives you time to make decisions, not excuses. There's one more cross-border subtlety before we land the plane. Because the regime taxes mainly Spanish source income, Spain does not treat you as a resident for treaty purposes while you're on it. In plain words, you cannot use Spanish resident treaty benefits to reduce foreign withholding during those 6 years. The regime is a great net for salary and a gentle fence for foreign investments, but it is not a universal treaty superpower. Keep that in mind if your portfolio relies on treaty rates to reduce foreign withholding on dividends or interest. The right custodian choices matter. When does the adventure end? Automatically after the 6th tax year, or earlier if you stop meeting conditions or you leave Spain. If you leave mid-regime, you must notify that you're out using Form 149 within 1 month. The day after the regime ends, you live in the normal Spanish system, worldwide income, progressive rates, and wealth rules that can look at worldwide assets depending on region. If you plan to stay in Spain long-term, start preparing in year 4 or 5 so the landing is soft. If you plan to leave, synchronize your exit with bonuses, vesting, and major transactions, rather than letting the calendar surprise you. The difference between "we planned" and "we panicked" is usually about 11 months. So when does the Beckham regime make sense? With a high salary move where 24% beats the progressive scale by a wide margin, especially if you expect to stay for up to 6 tax years. Layer in a foreign investment portfolio you'd prefer to keep outside Spain's net during that period, and the regime becomes a tidy ring fence. If your spouse and children move with you and their incomes are lower than yours, they can often join and share the same flat framework, as long as their tax bases stay under the main taxpayers. For remote workers and startup founders operating through the startup law, the 2023 updates were written with your badge on them. The biggest risk is treating this like a casual paperwork exercise. It isn't. It's a clock, a form, a handful of definitions, and a very good deal if you respect all 3. Most tax regimes make you learn a new language. This one asks you to learn a few nouns: Form 149, Form 151, AEAT, Social Security, treaty status, and then rewards you with a single verb: simplify. If you can keep that promise to yourself, Spain will keep the other one to you.